Hey everyone, Marshall here. Today, I want to talk about how index funds work. It's a great topic, an important topic for us to get into today, because index funds are straightforward investments designed to match the return of their target market. First of all, an index fund is a mutual fund, or it could be an exchange traded fund. And it's designed to follow certain preset rules so that the fund can track a specified basket of underlying investments. To do this, managers use one of two indexing techniques. The first is replication, and the second is sampling. So let's talk about replication first. Managers of many stock index funds use the replication method to track the performance of their target indexes. This means that a fund holds every security in its target index in the same proportion as in the index. For example, if a company stock made up of 1% value of the S&P 500 index, the manager of the S&P 500 index fund would buy and spend 1% of the value in that stock. Very simple. On the other hand, the second approach is the sampling approach. Managers of index fund that use a sampling method take a representative sample of the securities in the underlying securities that resemble the index. For instance, if a particular industry makes up 10% of the target index, a manager of the index fund invests 10% of the assets in that industry, even though the fund might not hold every single stock in that underlying industry. Managers of stock funds use sampling when the index is so large that it's too expensive to buy all the stocks in that index. Managers of bond funds typically use sampling because the size of bond funds is so large and it's so difficult to get every single bond in the bond market. Most people don't realize that the bond market is twice as big as the stock market. And so to create an index of that entire market would be extremely difficult to buy those bonds in a typical bond fund. An index is a collection of stocks or bonds chosen to represent a portion of the market. Investors use indexes to track market performance. Most indexes measure companies based on market capitalization. Market capitalization is determined by the value of the company. It's calculated by taking the total number of outstanding shares by the share price. For example, if a company's market cap is 1%, $1 million, and the value of the index is $100 million, the company would be worth 1% of the index. Some indexes, however, are price weighted. This means that each stock influences the index by the price per share. Higher stock have more weight and have more impact on the index performance. The Dow Jones Industrial Average is an example of a price weighted index. So let's talk about some common examples of index funds. The first one we just mentioned was the Dow Jones Industrial Average. This is the oldest barometer in the US stock market and the one most often quoted in the media. The Dow tracks the stocks of 30 major companies from a variety of industries. The next index, the second one, is the S&P 500, at Standard & Poor's 500, and it's synonymous with the market, okay? The S&P 500 tracks the stocks of the largest 500 stocks in the US. The third index is called the Wilshire 5000 Total Market Index, and it's a measure of the entire U.S. stock market. The Wilshire 5000 buys large companies, mid-size, and small companies. The next index is called the CRSP U.S. Total Market Index, and it represents approximately 100% of the investable U.S. market. The CRSP U.S. total market includes large, small, and micro cap stocks that are traded on the U.S. Stock Exchange and the NASDAQ. Another index that's very common is the Russell 2000. The Russell 2000 represents the smallest 2/3 of the 3,000 largest stocks. Kind of confusing. The smallest 2/3 of the 3,000 largest U.S. stocks. A little confusing there, but that's the Russell 2000 index. The next index that's very common and famous is the NASDAQ Composite Index. The NASDAQ Composite Index includes the stocks of more than 3,000 companies listed on the NASDAQ Stock Exchange, including stocks of many widely followed technology companies. And last but not least is the Bloomberg Barclays U.S. Aggregate Bond Index. This is an index of the taxable and investable grade U.S. bond market, including U.S. Treasuries and corporate bonds. Excludes low quality bonds whose issuers are considered more likely to default. So there you have it. What is an index, how it works, and some examples of the most famous indexes in the world. I'll see you next time. Bye for now.